Everyone, and welcome to the BetaShares Defensive Income Solutions webinar for today. We're excited to have so many of you tune in to listen to us talk about defensive income. My name is Ilan from BetaShares, and we'll be taking you through the presentation starting right now. Bit of background information as always. Please be advised that this particular webinar is general information only, so it does not constitute personal financial advice of any sort. It doesn't take into account any personal objectives or your own situation, so please make sure that you do consult a financial professional or read the product disclosure statements of any of the funds that we speak about today. For those of you who haven't been involved in our webinars before, a bit of housekeeping. A recording of the session plus all the slides will be sent to all attendees today after the event itself. There is an opportunity for you to ask questions interactively throughout the session by filling in the question widget there and just simply pressing submit. We will endeavour to come back to you with the answer to the question either during or at the end of the presentation itself. Today's presenter is Peter Harper. Peter is an executive director in the business and co-head of distribution and capital markets. He's responsible for the sales strategy and execution across all client segments, had formerly been with Macquarie Bank, ABN AMRO and UBS. And to get things started, before we move into the presentation, just a bit of interactivity here. If you could just look on the screen and answer the question. Over the next 12 months, how do you plan, or in fact, let's actually not do that one. Let's ask you one other one first. So the question is, in 12 months' time relative to today, how do you expect the Australian stock market to be trading? Higher, approximately the same, or lower? So really just getting a sense of people's sentiment in the market right now. So relative to today's levels, do you expect the Aussie Stock Exchange to be trading higher, approximately the same, or lower than today? Just give people a few seconds to fill that in. So just sharing what people have said there. Certainly not many people think it's going to be higher. So either the same or lower. And so obviously that is definitely a good thing for those of you interested in defensive income products and strategies. And on a similar topic, talking about defensive income, the question that we ask you to respond on is what percentage of your investment portfolio is currently in defensive income exposures? And just to define that, defensive income exposures to us is anything below equities in the capital structure. So hybrids, bonds, cash, etc. So we'll just let people respond to that. And the responses here show that the majority have less than 25% in their investment portfolio in defensive income, which is quite typical for most Australian individual investors. There are some with approximately 25 to 50% and a few with quite a lot, but certainly the vast majority in the lower end. So without further ado, then I'll pass it on to Peter Harper. One other point of housekeeping is that we do have handouts for this session. Those handouts are in the widget as well. If you click on that, you'll be able to find information on some of the funds that Peter will be talking about. Without any further ado, I'll hand over to Peter to take us through the presentation today. Over to you, Peter.
Thank you very much, Ilan, and most importantly, thank you to everyone for joining us today. It's always a pleasure to get to speak to everyone. We're going to kick off today's webinar. Look, I think it was probably shown in that poll that fixed income has historically been under-owned in the Australian market relative to offshore markets. So we're just going to cover off on a bit of fixed income 101. Please bear with us for those who are more familiar with bonds. We'll try and cover it quickly, but I think it's important to developing the discussion on defensive income products in the Australian market. We'll then look at the growth of fixed income and some ways to access fixed income exposures, as well as a checklist on how to select the right fixed income exposure for any investor. So what is fixed income? Look, technically it's an investment where periodic income is received on regular basis, on a regular interval at a relatively predictable level. In plain speak, what that generally means is bonds. So most people think of fixed income as bonds in their portfolio, and they can be issued by governments, local councils, or corporations. Bonds are typically considered less risky than equities, and that is because in the event of a company or defaulting, bondholders are paid out or have a higher claim on the assets of that business than do equity holders, and therefore they're considered less risky generally than equities. Most people utilise bonds for two key purposes in portfolios. One is for a defensive income stream, and the second is to act as a diversifier to other investments that they hold within their portfolios. And some bonds traditionally have a negative correlation to equities, which means historically they've gone up in value when equities have fallen, and vice versa. Now that can be useful for mitigating risk if you expect a difficult market environment ahead. This chart here shows the capital structure of an Australian bank in this instance, but it could apply to a corporate also. And you'll see that at the very top of the capital structure is what's known as covered bonds. So they're bonds that a bank issues over that are guaranteed by a specific claim over a specific asset. Below that sits cash and term deposits, then corporate bonds, subordinated bonds, hybrids, and equities. So as you move higher in that ladder, you have a higher claim on the assets of that bank, and therefore the investment is considered generally less risky. However, conversely, the more you lower your risk, the lower your expected return would normally be. Let's just cover off quickly on some fixed income lingo. Maturity. Well, most bonds, people don't normally want to lend money in perpetuity. They actually want to know that if they lend money to someone, that there's a set date on which they get it back. And so the maturity of a bond is the pre-agreed date on which the capital that's lent to the borrower will be repaid. That leads to a concept of duration. And duration is a measure of the price sensitivity of a bond to changes in the level of interest rates. And it's generally expressed in years. So if a bond has a duration of, say, 2 years, what that means is that if interest rates fell 1%, the bond would be expected to go up in value by 2%. And if you had a duration of 5 years, then a 1% fall in interest rates would be expected to increase the value of the bond by 5%, and vice versa, of course. So generally speaking, the longer the maturity of the bond, the longer the duration of the bond, and therefore the greater the sensitivity of that bond to changes in market interest rates. The other way to just quickly think of duration is that it is the compensation you receive for locking up your money for longer periods of time. So the longer you lend to someone, the greater the opportunity cost of not being able to use that money, and therefore the higher rate of return you would expect. So the other factor is the longer the duration of any exposure, or the longer the maturity, the higher the return you would expect to receive. And that's really no different to a term deposit. Term deposits aren't marked to market daily, but they do have duration in them. And you would obviously expect to be paid more on a 3 or 5 year term deposit than you would on a 3-month term deposit. Bonds work in exactly the same way. Credit risk. Credit risk is the risk you take on of your money not being repaid or of a default occurring whilst during the period you've lent out that money. So with something like lending to a government, as in the case of a government bond, governments are considered generally to be risk-free. So they're not considered to have any credit risk because it's basically considered that you're largely guaranteed to get your money back. I'm sure we could all point to a few examples offshore where that may not necessarily be the case, but at least in the instance of Australian and US governments, that would be expected. So when you move to an issuer who is less creditworthy than the government, you gradually take on more credit risk, and that has the effect of increasing the return you would be likely to demand and therefore receive. So higher credit risk leads to higher expected returns. Investment grade, when we talk about that talks about ratings houses such as S&P and Moody's and the ratings that they put on various bond issuers. You'll often hear terms like AAA rated or A rated or B rated, etc. Any bond that is rated BBB or better is considered generally by the research ratings houses to be considered investment grade, i.e. high enough quality for investors to consider making an investment into. There are two primary types of bonds. There are fixed rate bonds, and more recent times we've seen the development of floating rate bonds. So what are the differences here? A fixed rate bond is a debt security issued by a company that pays a regular and fixed dollar amount of interest for each agreed period, and that's known as a coupon. And that coupon that you receive does not change regardless of changes in interest rates. As a very quick aside, I'll just tell you why it's called a coupon. In the old days, you used to, if you bought a bond, you would actually be handed a physical bit of paper that you would then go and store in a safe deposit box or whatever. And to get that money back at maturity, you'd have to go and hand back the paper bond that you received. To get yourself paid regular income, there would be a series of little coupons attached to the side of the bond. And you would tear off this month's coupon, go down to the issuing organisation, hand in the coupon, and they would hand you cash in return for the coupon you handed them. And so those regular interest payments on bonds in the old days were received when you handed in the coupon, and therefore they became known as coupon payments. So with a fixed rate bond, the coupon amount is fixed. If it's 5%, you get 5% divided by 12 every single month or every single agreed payment period. And that never changes regardless of whether market interest rates go up or down. In a floating rate bond, the coupon you receive varies over time. So much like a floating rate cash deposit, if interest rates go up, the rate you receive goes up in a floating rate bond, and if interest rates go down, the rate you receive goes down in a floating rate bond. Now, the way the floating rate that you receive is determined is normally by a set margin over a market interest rate. So banks normally use something called BBSW, which is for simple purposes, it's somewhat of a proxy for the rate that banks lend to each other on a daily basis. And it's not dissimilar to, say, the RBA cash rate. So a floating rate bond is issued at normally a fixed margin over BBSW, say 1%. So if interest rates were at 1%, or in fact, we'll show you an example right now on the next slide. Let's look at BBSW at 1% and imagine that a floating rate bond has a margin, a fixed margin over BBSW of 1%. What would your total interest be? Well, you'd get the 1% BBSW plus the fixed margin of 1% on top gives you a 2% total interest. If market interest rates, as measured by BBSW, went up by 50 or 0.5%, to 1.5%, you would still receive that margin over the new market rate of 1.5%, giving total interest of 2.5%. And similarly, if BBSW went to 2%, you would still receive that fixed margin over BBSW, would now give you total interest of 3%. So as that market interest rate moves up and down, your total interest percentage moves up and down. So let's have a look at an example of a fixed rate bond versus a floating rate bond. Let's you get $100 at the end of this year, and the current market interest rate is 5%. That being the case, you would expect a floating rate bond, we're looking at the middle row here, to return 5% in interest, being the market rate, and you would expect your capital market value of your investment to stay at $100. That's pretty, capital stable. If interest rates were to drop, so going to the top row now, to 2.5%, then what happens? You'll see that there's no impact on the market value of your investment, but your interest payment declines to $2.50 from $5. And if interest rates in the market were to rise, looking at the bottom line now on a floating rate bond, well, what would happen? Interest payment would rise correspondingly to $7.50, but your market value remains fairly constant at that $100 rate. So the key point here is that in a floating rate bond, when market interest rates move, that move is reflected in the value of interest paid to you, not in the value of your capital invested, which remains fairly constant around that initial level of $100. On a fixed rate bond, the variation is different. What happens is the interest payment remains constant, but a change in market interest rate results in a change in the capital value of the bond. So if rates fell from 5% to 2.5%, you would still receive that same $5 worth of interest despite that fall. But you would also receive an increase in the capital value of your bond. Why is that? Because the market would be prepared to pay more for a bond that is now paying above market rates of return. And vice versa, if market interest rates went from $5 to $7.50, or 5% to 7.5%, you would still only receive 5% return, and the value of the bond would decline to $97.70. Why? Because people wouldn't want to pay $100 for a bond paying 5% when they could go and buy a bond in the current market for $100 paying 7.5%. So that tells you one thing. For floating rate bonds, market interest rates don't tend to have much impact on capital. Rather, it has an impact on the rate of return received in the form of interest. For fixed rate bonds, when market interest rates decline, that tends to push the value of a bond up. So you get a capital gain. And vice versa, when market interest rates rise, it tends to push the value of a fixed coupon bond down. So that covers fixed and floating rate bonds and the differences between them. Essentially the difference being where the valuation change mechanism is, whether it's in the cash interest received in your pocket or whether it's in the capital value of the investment. What about hybrids? Well, hybrid securities combine a combination of both debt and equity characteristics, thus the name hybrid. So they have some debt-like characteristics. They do rank ahead of equity in the capital structure of a bank or corporation, but they rank below pretty much all other forms of bondholders and debtors. They pay a regular and defined rate of return, usually based on a floating rate, and they have a fixed date for optional repayment or conversion to shares. Some of the equity-like characteristics are they're generally perpetual instruments. An issuer may suspend distributions or delay redemptions in a hybrid security, which isn't normally the case for bonds, except under a default scenario. They're subordinated on the capital structure, as we mentioned, and in times of severe distress, hybrid securities can be written off. We've certainly seen instances of that. in offshore in Spain most recently. Why defensive income now? Well, because we're quite a way into a bull market, and that doesn't mean it's going to end tomorrow, but it does mean that you should be starting to think about how you're going to position your portfolio for when a bull market inevitably does end. The other factor is that as we've seen rising interest rates globally around the world, what that does is incrementally and little bit by little bit, it makes bonds relatively more attractive compared to equities. And so given we do seem to be in a rising global interest rate environment, it would probably be prudent to start investigating fixed income exposure now to be ahead of the curve. Okay, here we've got the growth of fixed income ETFs in Australia, and you can see they've received very strong growth in both market capitalisation and the number of products available, particularly since March 2014. Also, to give you some example, we have actually seen that fixed income investments had a record year in 2017 in terms of growth, and that's probably driven partly by those two factors I mentioned. We're getting deeper into a bull market, and the rising global interest rate environment is bit by bit making fixed income more attractive. Yeah, we're on track in 2018 to surpass 2017's flows by 20%. Moving on. So when we think about fixed income, I mentioned at the start there were two forms of return that you can generate from fixed income exposures. First of all, you can generate a return from duration or interest rate risk. So the longer the horizontal axis shows an increasing level of credit risk. So what we've got here are three floating rate products. They've got no duration or interest rate risk, or very little. We're looking at three floating rate products, and we're step by step moving down the capital structure of a bank or corporate, increasing risk more as we move from left to right, and therefore enhancing expected returns more as we move left to right. So something like play, you would see there a cash product, and so very little or no duration, and sits right at the top of the capital structure, so less credit risk. You then step over to the right to a product like coupon, which is senior floating rate bonds from major Aussie banks. Now, that is still very high in the capital structure, does sit below cash, and as a result, you would expect to earn a higher return than cash. Then you step right out to the far right-hand side of the horizontal axis to hybrid. You're looking at a security that has a blend of equity and bond characteristics and sits only above equities in the capital structure. So as you take on greater credit risk by virtue of being lower in the capital structure, you would expect to receive higher returns from that. If we look at the vertical axis now, you'll see return from duration or interest rate risk. What you've got there is you'll see we start seeing some of the common bond benchmarks in Australia, both of which have some duration. Bloomberg Ausbond Composite Index and Bloomberg Ausbond Credit Index. And then we rise further on the interest rate or duration profile up to CRED, which is our senior investment grade corporate bond exposure. Now, this being a fixed rate exposure does incorporate duration. And so you can see CRED has two sources of return. It generates return from taking on duration interest rate risk, but also generates return from taking on credit risk or lending to corporates. So two opportunities to earn a return as opposed to just one. Now, traditionally, many investors in Australian fixed income have invested or looked at a benchmark. There are several of them, but not to pick on one, I'll just take Bloomberg Ausbond Composite. That's the most probably widely known. They look at a benchmark like that when comparing their fixed income. Now that has a couple of, these traditional broad market exposures have a couple of problems in our view. First of all, these broad market benchmarks tend to be liability weighted. So what that means is they lend more money to the most indebted issuers in the market. So the bigger the value of bonds you have out there, the more debt you've issued, the more weighting you get in the index. They also tend to have very unstable risk profiles. So like the Bloomberg Ausbond Composite Index, if you went back a few years ago, that index would be a mixture of government bonds and corporate bonds. However, as the federal government has run a deficit program over the last few years, the federal government has been issuing more and more bonds or debt into the market. And that debt is large and significant enough to be included as part of. So over time, you can broad market return from duration and government bonds, and less return from credit exposure, which has impacted the overall return of those sorts of indices. Now, here's the three problems really. I'm going to ask you, why does it make sense to invest in a broad market benchmark that's liability weighted and therefore lend more money to the most indebted issuers? If you were going to lend money to your friend, would you go on the highest level? I would suggest not. Yet that is what these broad market bonds do each and every day. Secondly, if you're going to buy an investment that tracks a broad market bond index, effectively the outcomes of that index in the future are likely to be controlled by the funding needs, deficits and issuance requirements of the federal government. How does it make sense to play funds? Thirdly, because you don't know what the outcome is going to be, because it is driven by such as whether the government issues or not, how can you accurately predict what your investment outcomes will be from a broad market bond index if you don't have any predictability in terms of the risk profiles of those exposures over time? The perfect example of this is that the duration or interest rate risk of the Ausbond Composite Index has gone from about 3.5 years to about 5.2 years over the last 18 to 24 months, purely as a result of the federal government issuing more bonds to interest rates and to cover deficits. So, what's the alternative? The alternative is probably for many investors to consider active management for their bond portfolio. And we're the first to admit that there are active managers out there who can add value. Here's the problem. It's difficult to find them, and it's difficult for any of them to do it on a consistent basis. Here are the stats from the S&P SPIVA report, which stands for the Index versus Active report. In 2017, 69% of active Australian fixed interest managers underperformed those what I believe to be flawed broad market benchmarks that I just described. Over 10 years, 85% of them have underperformed those same broad market benchmarks. That means it's incredibly difficult to find a fixed income manager who's going to consistently outperform the market. So investing in the existing benchmarks looks problematic. Investing with active managers on the whole looks problematic. So what's left for investors? Well, when considering that question, we've looked at a range of principles that we think are core to fixed income products. First of all, fixed income products need to deliver efficient, liquid, and low-cost outcomes that allow investors to use them as building blocks of an asset allocation profile and broadly diversified portfolio. Products need to be robust from a trading and liquidity perspective, therefore have to focus on the most liquid parts of the fixed income market. Well, in many of the broad market indices, you'll find hold other obscure and difficult to access exposures, which means diversification can come at a significant cost. Fees matter, as do bid-ask spreads. Income is traditionally a low returning asset class, and therefore you cannot afford to be giving away any of your return potential by paying too much in fees or by paying too much in bid-ask spreads. And you need to have a stable risk profile so that you can accurately or with reasonable accuracy predict what your investment outcomes are likely to be. Here's where it gets interesting. What's the checklist for choosing the right fixed income exposure for you? Well, it's going to depend on the fixed income. For many investors, that's exactly why they're buying fixed income. Here's a problem for you, and we'll cover off on this more in a little bit, but we talked about return from fixed income coming from two sources, credit and duration. Well, credit positively correlated to equities, which means historically it moves in the same direction as equities. So if you buy a floating rate exposure that only generates return from credit, then if your equity portfolio sells off, historically your fixed income portfolio would be selling off at the same time. Maybe not by the same extent, but nonetheless likely to be moving in the same direction. So credit does not provide diversification from equity risk. If you want equity diversification, you need to have duration in your fixed income portfolio. And duration is achieved via fixed rate bonds. What about income? How much income stability do you want? Do you want to know that you've got approximately the same amount coming in each and every month? Or are you happy, as would be the case in more of a fixed coupon exposure, or are you happy to let your investment income vary both positively and negatively as market rates move up and down? What's your market view? We saw before that for a fixed coupon or floating rate bonds, capital value is fairly stable. It's more the income that changes as market rates move. For fixed coupon bonds, the opposite is the case. The month-to-month income is stable, but the capital value can fluctuate as market interest rates move up and down. So if we know that with fixed coupon bonds, falling rates generally lead to higher capital values and rising rates lead to falling capital values, that can be important in your investment decisions. Remember, the fixed income curve is already priced in to current fixed income investments of both types. So if you think rates will stay lower for longer than what's priced into the existing fixed income curve, then you would probably have a preference for a duration exposure or one of more fixed rate variety. If you think rates will rise in line with what's already priced into the market, then you would be relatively ambivalent between holding floating rate exposure or fixed rate exposure. And if you think rates will rise higher or faster than what's priced into the existing market, then assuming you don't need equity diversification, you would probably opt more for a floating rate exposure. Finally, it's important to consider return potential and quality of the portfolio when ticking off your fixed income exposures. So what's that mean in terms of selecting exposures? Well, it's just high yield you're after. Any of those exposures, coupon, hybrid, credit, all offer a high level of yield relative to equivalents in their individual areas. So I think you need to look a little bit beyond that. It's capital stability that you need in combination with high yield. Probably look more at the floating rate part of the suite, being AAA cash, coupon for senior rate bonds, or hybrids for actively managed hybrid securities. If it's diversification you want away from equity risk, then you need to be looking at a duration exposure or a fixed coupon exposure, and that's where something like CRED can be useful. All these products have monthly distributions, and I think probably provide some pointer based on your underlying needs as to where you should be looking. This chart here is designed to show two things that I touched on, so I won't spend long on, but essentially fixed income is a low returning asset class, and so you cannot afford to be giving away return either in management fee or in bid-ask spread. I've put here the BetaShares products up against the alternative ETFs from other providers in the market, and what you'll see is we generally have the cheapest or very close to the cheapest MER, and similarly the tightest or very close to the tightest spread. So we feel across the full spectrum of the suite, we're highly competitive in terms of reducing drag from fees and bid-ask spreads for investors, and that's very important. Additionally, what those tight spreads tell you is that I mentioned at the start, by eschewing the broad market benchmarks, we are able to focus on holding the most liquid parts of the fixed income curve, and that flows through to tighter spreads. It also matters in a defensive asset class, because why are you in fixed income? But defensive properties and knowing that it will be there really need in a terrible market event. Now, in a terrible market event, what is more important than liquidity? You need to be looking for the most liquid fixed income exposures, which a good proxy for is those with the tightest spreads. Onto the products one by one now. Just looking here at AAA, the High Interest Cash Fund. This is our largest fund. It's got a bit over $1.2 billion in assets. And many investors would be familiar with a cash management trust, a unit trust that holds cash investments. AAA is no different. It is simply a conventional unit trust that holds cash deposits. The only difference is it's listed on the ASX. The rate of return that's paid on those cash deposits after deducting all fees is currently 2.01%. So that's 50 basis points above the RBA cash rate and a very high level of return relative to most alternatives I'm aware of out there. You can see there the banks that we hold deposits with. One step down in the capital structure from cash deposits was senior floating rate bonds. And that part of the capital structure is covered by our coupon exposure, QPON. So here we're talking about senior floating rate bonds from major Aussie banks. 80% the big four, 20% the regionals, equally weighted. Now, why we think this is interesting is that senior floating rate bonds actually have the same default risk as cash deposits. So what I mean by that is that if a bank defaults on their interest payments on a senior bond, they're not allowed to pay interest on cash deposits, and vice versa. So very similar levels of default risk. However, in the event of a wind-up, cash does sit above senior bonds. So similar levels of default risk, but something like coupon is generating a yield to maturity of about 2.83%. So you're getting about 130 basis points over RBA cash, or about another 80 basis points over AAA. So for a very small step down in the capital structure, you're able to generate quite a bit higher return, albeit with small risk of capital fluctuations. To give you some idea of the size of those capital fluctuations, the volatility of coupon you can see in that top row there has been 0.5% compared to the Aussie equity market at 17.3%. So a mere fraction of the volatility of equities, and the biggest drawdown on a total return basis for coupons index in the last 10 years has been 0.8 of 1%. So is it completely capital stable? No. Does it have a very high level of capital stability? Yes. Is the added return over cash worth that slight variation in capital over time? That's for each investor to determine in their own right, but we think it's an interesting part of the risk-return profile. Now we'll move on to cred. So here we move from AAA and coupon, which were floating rate products, so generating their return from credit exposure with virtually zero duration, over to cred, which is a fixed coupon bond holding both credit and duration exposure. So generating returns from both. It's senior investment grade corporate bonds, and those bonds must be issued in Aussie dollars and domiciled in Australia. 25 basis points, making it the cheapest exposure in the market. Here you're looking at an average yield to maturity of 3.92%. That's quite a bit up on the 2.8 odd we saw in coupon and the 2 odd % in AAA. Why are you getting a bigger return? Because you've got two sources of return here. Interest rate risk via duration and credit risk. So by having two sources of return, you generate a higher level of return. There's also the possibility, all other factors being equal, of some very small capital gains being potentially received in this fund over time as we rebalance bonds into newly issued bonds at cheaper prices. That's a fairly technical aspect. I won't go into it too much, but you're looking at a potential added return from that of about 80 basis points. That's known as roll return, which based on the current shape of the interest rate curves gives an expected total return of about 4.72% at the moment. Why I mention that is that it's duration that provides the diversification from equities. I've said that many times. So this product, by virtue of having duration, is one of the best equity diversifiers we're aware of in the market. But with an expected total return of around 4.72%, it's also one of the highest returning exposures in the fixed income market. So not only is it giving you the best diversification away from equities, but also providing the best compensation for that diversification and at the lowest cost. This chart here shows the return of active managers in the Australian market compared to cred, and it's the 5-year return. As we move from left to right, we see better returns. And what you can see is cred's return has been an absolute positive outlier at around 6.5% annualised relative to all active managers in the Australian bond environment. So you didn't have to pay big fees to do a lot better than the active managers. So asset allocation, I mentioned again, 3 sources of returns: equity risk, duration risk, credit risk. Let's look at how they interact together. Duration and credit are negatively correlated. That means when you're making money from duration, you're likely to not be making it from credit and vice versa. They're likely to move in opposite directions from each other. Now, over the long term, that can actually be beneficial for something like cred, which has both. And the reason why is you have the opportunity through the cycle to generate returns from both duration and credit. However, in the shorter term, the negative correlation of those and the fact they move inversely to each other dampens a lot of the noise or day-to-day risk that could be experienced in those exposures. What about equities and credit? Well, as we said at the start, they're positively correlated. So when equities are selling off, credit tends to sell off too. Maybe not to the same extent, but they're likely to be moving in the same direction. So will credit exposures that have no duration, i.e. floating rate exposures, provide diversification to equities? Well, look, they'll have low correlation to equities, but they're likely to be positively correlated nonetheless. So if you're invested in floating rate product and the equity market sells off, you should probably expect the floating rate product to be more defensive, but you should probably expect it to sell off to some extent as well. Equities and duration. This is where fixed coupon bonds come in. Negative correlation. So if you're looking to protect yourself against an equity sell-off, then having duration helps protect against that, because when equities are selling off, duration exposure is likely to be rising in value. So if you want your bonds to protect you against equity risk, you should probably consider bonds that have fixed coupons, such as credit. All right, on to hybrids, just to finish off. Hybrid securities have been a retail-focused market for a very long time, and retail has been attracted to them by the fact that they tend to pay higher returns, albeit those returns come at higher levels of risk. Now, one of the issues with hybrid securities being a retail-dominated market is that they tend to be very much buy and hold investments for many of those retail investors, and therefore liquidity is not particularly strong. That means that larger trades can push the valuations of hybrids around and away from their fair value. Similarly, not many retail investors have the ability to value a hybrid security and know whether it's trading at fair value, whether it's trading cheap, or whether it's trading expensive. So it's what we call an inefficient market. That means there's a great opportunity for active managers and professional managers who have valuation models and can price these securities to take advantage of those inefficiencies. Similarly, hybrids are quite complex securities. As a result, we think it makes sense, specifically in the hybrid part of the market, to employ a professional active manager who intimately knows all of the intricacies of those complex security types. Thirdly, most investors who hold hybrids directly, and I acknowledge each investor is different, but our feedback is they tend to hold 3 to 5 hybrid securities. That's not a very diversified hybrids exposure. By buying into a hybrids fund actively managed, such as HBRD, you can gain instant exposure to between 20 and 50 hybrid securities. So much higher diversification there. So when we look at HBRD, what are we looking at here? We're looking at an actively managed portfolio of hybrid securities that is designed or with an objective of providing after-fee returns greater than the Australian Hybrids Index. It also has an objective to provide an absolute return of the RBA cash rate plus 2.5% over the medium term. What that means is we don't want to outperform purely because we didn't fall, the market fell, but we didn't fall as much. We want to outperform by providing positive absolute returns over the long run. We want to provide post-fee franked income or running yield that's generally similar to the hybrids index, so that people don't have to forego income to move into this actively managed, more diversified hybrid exposure. It also has the ability to move out of hybrids into more senior ranked securities such as cash and bonds to, above all, help protect investor capital should hybrid securities be at risk from overvaluation or wipeout events such as we saw with some hybrids in Spain this year. Looking at performance, HBRD in orange there, actively managed, has net of fee outperformed the broad hybrids index since inception. Albeit I would caution that that's a fairly short period. The fund is coming up to only a year old at the moment.
All right, excellent, Pete. Well, look, that concludes the formal part of this presentation. Peter's gone through a number of products in the defensive income space that BetaShares offer. Just on the slide there, some things that you need to consider from a risk perspective. You can read those at your own leisure, but of course, there is market risk associated with fixed income in all the products we've mentioned. As I mentioned before, this is not a personal advice session. And of course, some of these products are actually relatively concentrated because the issuance of many of these products is primarily by banks. Now, we've just probably got 5 or so minutes to go through a few questions. We've had quite a large number of questions. So I'll just pick out a few of those for you. Just in relation to the most recent product you just spoke about now, HBRD. A question from Jody is, who are the active managers managing HBRD?
Thank you, Jody. HBRD is managed by Coolabah Capital. They're one of the largest managers of hybrid securities in the Aussie market and one of the top-ranked short duration credit managers in Australia. All of the fixed income exposures issued by BetaShares have Lonsec recommended ratings also.
A question again on CRED now from Paul. We had a chart there which spoke about how CRED had gone relative to the active managers, and he's just asking the question, how can we say that given it's only been on the ASX for a few months?
Paul, excellent question, and my apologies. It was remiss of me to not point this out directly, but whilst CRED has only been in the market for a few months, its index has been available for a longer period of time. And the returns that I showed for CRED of 6% over the long run were the returns of the index after subtracting the management costs of CRED each and every year.
Excellent. So there was a question as well there about a diversification in a sort of a GFC event, and which of the, and specifically back to CRED, which of the funds, would CRED provide a diversification in the case of a GFC event? In other words, essentially a diversification against a downturn in equities.
Yeah, look, very, very fair question. Obviously, past performance is not indicative of future performance, so we can never guarantee what any exposure would do. But if historical correlations, negative correlations between duration and equities stacked up in the future, as we would probably expect them to, then yes, CRED would have provided amongst the most effective exposures in terms of cushioning equity downside during the GFC. I actually have some numbers here. In 2008, February to December, the ASX 200 was off 30.5%. CRED's index, and this is before fees and the index number, I'll make sure I clarify that second time round, was up 18.8%. So equities off 30.5%, CRED's index up 18.8%. The other year we've had negative equity returns since the GFC was 2011, and the ASX 200 was off 10.5%. CRED's index was up 13.9%, again, before fees. So, you know, in terms of looking at the index performance, if past performance is any indication of future performance, then it would suggest CRED has a strong potential to provide a defensive exposure when equities sell off.
All right, so just probably time for just two more. One question that's actually a good one, just in terms of the basics of ETF question that somebody's asked is essentially questioning whether, because, for example, CRED, or for that matter, any of the funds we've spoken about today are trading on the ASX, does that mean there's going to be any ASX trading risk? In other words, is it just fixed income risk you're dealing with, or is it something to do with the ASX share market that will somehow affect the price of any of these funds?
Sure. So these funds, their price day to day is influenced by the value of the underlying investments that they hold. Hybrids, for example, hold hybrid securities listed on the ASX. The other exposures tend to hold cash deposits or bonds that aren't listed on the ASX. In terms of trading risk, what would you say? Look, obviously, if the ASX market is closed due to some technical error, you wouldn't be able to trade an ASX traded ETF, nor would you be able to trade any ASX traded investment. So from that perspective, I suppose there's some ASX trading risk. Yeah, I mean, from the point of view of if ASX shares sold off, would that impact these securities? Well, not directly.
Excellent. And finally, just a very simple one. Are franking credits passed on to investors with the distributions from HBRD?
Yes, franking credits are passed on to investors in distribution for HBRD. I might just roll on. There was a separate question about what about the Labor Party and franking credits. Well, look, I'm no tax expert, so you need to seek your own advice. I'll speak generally based on my best understanding, but you'll need to verify all of this for yourself. My understanding is that, well, first of all, franking is only applicable out of all these investments we've covered today in HBRD. The other exposures do not have franking. Secondly, my understanding is that Labor proposals would only affect your ability to actually be cut a cheque for franking credits from the ATO. It would not affect your ability to use franking credits to offset income from other sources. So, I mean, would that policy be a positive for anything that's got franking in it? Probably not. Would this be affected any more than that? Probably not, that I'm aware of.
Very good. Well, thank you everyone for your attendance. Just to remind you again, this presentation and the slides will be sent to you via email later today. We do apologize. We know there was a bit of sound issues today. I think the internet gremlins were playing havoc with us. Unfortunately, it was beyond our control. We apologize for that. You will receive the slides. And of course, if you have any questions, please do let us know. We thank you all very much for your attendance and look forward to being with you again in the near future.
Thanks. I'll just say thank you from me, and I should just say on franking as a final thing, with rule changes or potential law changes, at the end of the day, what makes it difficult to predict these things is that those law changes would impact individuals based on their underlying circumstances rather than any market as a whole. So the fund would continue to generate franking credits in the same way. What would change potentially is some investors' ability to use those franking credits. So the impact on the fund would be virtually zero, but the impact on individual investors will depend on their personal circumstances.
Excellent. So you can see on the screen there's a number of ways you can connect with us via our newsletter, via, of course, all social media channels, and, of course, directly with us via the phone. We look forward to being with you again shortly, and thank you all for your attendance. Bye-bye.